Welcome back to, and thanks so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Scott Kirshner, and Chaz Price. 419-794-3030 is the phone number. ARHQ.com is the website. Don't forget, if you missed previous editions of the show or just the first half of the show, you want to catch up, all available via podcast. Check out whenever you've got the time. Just search for America's Retirement Headquarters in your podcast medium of choice, or YouTube as well. A lot of great videos up there. Earlier in the show, guys, we were talking about life insurance, and we're going to continue that conversation a little bit. Right now, tax rates are historically low, and the government spending is at record levels. So a successful step in planning for the future, not only saving money, but keeping the government away from your money, a good proper tax strategy. We've heard you say, the biggest or second biggest asset a retiree owns, their retirement accounts or their home. And since traditional retirement accounts like 401ks and IRAs, which we talked about earlier, can be taxable in the future and at death, incorporating cash value life insurance into the planning phase can be important. And life insurance can also provide tax benefits. So what exactly does that mean? How does that work? What is tax-free life insurance?
Well, Nolan, you actually mentioned this in a previous segment, like you said, Chris, there. So one of the things I think I want to clarify for a lot of people out there is when we say what does tax-free life insurance mean, it does not mean, the death benefit. The death benefit is passed on to the beneficiaries tax-free. Mm-hmm. I don't think that's what the question is, and I don't think that's what we're asking for. But, the policyholder's death, upon their death, typically all of the life insurance proceeds is passed on to the beneficiary tax-free. That gives you a valuable tax advantage there to all of the beneficiaries. And like you mentioned earlier, Nolan, if you, God forbid something were to happen and, you're a 401k, all of those funds are going to be transferred over and those are going to be taxable. But if you don't need to access those, you can use the proceeds from a life insurance policy to make some of those payments on, the debt or, what have you, tax-free. But the real question is, what does actually a tax-free life insurance mean? That's not what we're referring to, right?
Well, I do think the death benefit is important, as we were talking about. Again, I'm 47, so if you think about somebody in their 40s or 50s, heaven forbid if they pass away before getting to retirement time, the nice thing about me having life insurance is the insurance company is just simply going to write a check to my wife because she's my beneficiary. Mm-hmm. She could take that money and she could do anything that she wants with it. She could use it as income replacement. The nice thing about using it as income replacement, it's not taxable because, again, it's tax-free death benefit. Now, in addition to that, again, being in my 40s, if my wife would happen to have me pass away, she'd have to get affordable health care. Mm-hmm. And under the Affordable Health Care Act, it's an income, not an asset-based test. So, had I not had life insurance and had she just taken money out of my retirement account, she could be subject to additional tax penalties because, traditionally with a retirement account, you have to be 59 and a half. Now, again, there could be some variations on what she does with it at the time of death, but either way, it's going to be taxable when she takes it out. If she takes out money from an IRA or a 401k, where the life insurance is much more taxable, favorable for her. But the other part that we're talking about is building up some benefits that could, potentially provide future tax benefits and help avoid taxes. I went on the internet and I was just looking at, just the different ways that people get taxed, federal income tax, state income tax, Social Security, Medicare taxes, sales taxes, property taxes, capital gains, estate tax, gift tax, state and local, and on and on and on. It goes on and on and on. So one of the keys to being successful is if you look at the wealthy, they figured out a way to keep the government away from their money. And I think that's what all of us need to do is make sure that we have a system in place designed to keep the government away from their money and all of these excess taxes that we pay. The cash value component of a life insurance policy, it can potentially grow tax deferred, meaning that you're not going to pay any taxes with the contributions and the money that you put into it, and on that growth potential, as long as those funds remain within the policy. It's obviously important to note that there's different rules and conditions that govern the tax treatment of cash value life insurance, and it's always a good idea before you do any changes or take any withdrawals, always consult with your CPA or accountant, and know how it's going to apply to your situation. But that tax-deferred growth is a nice advantage that allows that policy to accumulate so the government's not taxing it every year like they do with your checking and your savings account. It allows it to have that compound growth over time. And then with getting the access to the money, so in the event that there is no premature death, which is what I think everybody's goal is, at retirement time, what you can do is you can set it up with policy loans or withdrawals. You can typically withdraw funds from your cash value policy without immediate tax consequences up to the total amount of your premiums that you've paid. This is known as your cost basis within the policy. So let's just say at time of retirement, your policy is worth $400,000, and $200,000 is the amount of premiums or money that you've paid in. That $200,000 is your cost basis. These withdrawals are considered a return of your premium, and they're not subject to the income taxes. Now, the second part, the $200,000, if it had growth with it, what you could do on that part of the policy is to access that cost value through a policy loan. When you take out a loan against the policy's cash value life insurance, the borrowed amount is not considered taxable income since it's a loan, not a distribution. And, it's important that you have to repay that loan to avoid potential tax implications, or that loan would need to be settled upon death through the death benefit proceeds as well. The last thing you could do is you could, of course, surrender the policy. But, if you surrender the policy, that could be a taxable event. I was talking to a gentleman last week, and his needs have changed a little bit over the years. In his case, he doesn't need the policy anymore for the death benefit proceeds. He also has the ability where he could look to take that money and do something called a 1035 exchange, and take the policy and exchange it for like an annuity account or another type of contract that maybe was more suited towards what his income or his needs are now that he's at retirement time, not married, doesn't worry about leaving a legacy. So it's really a good strategy as well. So again, if you're worried about all the taxes that your family could pay in the future, and you want to learn what does tax-free life insurance mean, let's have a conversation about it. We'll talk to you about running a tax roadmap for you. So if you haven't had a tax roadmap done for you, we can take all the information off your last year's tax return, input this information of what things look like income-wise this year, run some future projections, do some analysis. And I know, Chaz, one of the things that you do oftentimes in those meetings is doing that analysis and looking at, the probability of success and talking about the importance of trying to keep the government away from your money. I think, something that you said that stuck out would be, what a shame it would be to make somebody a little bit more interest on their hard-earned savings, to not think about it tax-wise and just have tax rates go up in the future and end up paying 10 or 20% more in taxes and lose all that hard effort. And the only person that would benefit from that is the government with higher taxes.
Sure. Right, exactly. I think it is. I think everybody recognizes the fact that insurance has a ton of value, and that the tax benefits associated with life insurance are going to depend on your personal, tax situation. So it is right to talk to an accountant or a CPA. But additionally, I think the number one thing our listeners can remember is that life insurance is something that you're going to use to protect your beneficiaries and your loved ones first and foremost. And as we were doing the research for this topic today, I was kind of blown away at how many Americans don't have it, or don't have enough of it, which is really mind-boggling. There was a research study that I downloaded today in 2019, and it said that the life insurance from 2011 to 2019, the number of Americans that have it dropped from 63% down to 57%. So less people are buying insurance, and as many as 4 in 10 households don't have any or are underinsured. And so I think the bigger concern, not that people don't value it or don't get the advantages of it. There's tax advantages, there's tax deferred growth, there's the ability to borrow from the policies and earn interest and use some of that cash value to supplement retirement. But I think one of the reasons why people don't typically buy it, one being mortality. People don't like to talk about the D word, death. But the other is I think they sometimes get lost in the sauce. they get into kind of a paralysis or an analysis paralysis. The shopping process can be overwhelming and trying to understand which policy is right for you. Is it term? Is it permanent? And so that's okay. That's totally normal. That's not your job to be an expert at the complex world of insurance. That's where we come in here at the Retirement Guys. You can work with an insurance professional is just kind of the person to guide you, to navigate your caddy, if you will, for insurance, to kind of guide you through that process of selecting the best policy that's best suited for your needs, your budget, your financial objectives, and your tax situation.
The markets will fluctuate. They're going to go up and down, as we said many times here on the show. But when it comes to especially taxation and this fact that that's almost certainly going to go up in the future, once you write that check to Uncle Sam, it's not coming back. So being able to enjoy what you make and keep more of what you make, all sorts with that proper strategy where there's just, having that tax roadmap done. Maybe it's looking at things like cash value life insurance or whatever the situation may be. It all starts with a phone call to the team at America's Retirement Headquarters, 419-794-3030, or visiting the website, arhq.com.